The FASB and IASB are nearing the end of their joint redeliberations of the 2013 exposure drafts on leases. While the boards reached converged decisions on many aspects of the project, their views diverged on some key areas that will impact the comparability and complexity of financial statements prepared under US GAAP and IFRS. However, the changes to lessor accounting will be modest. The boards agreed with user feedback that lessor accounting under current guidance works well in practice, so the existing lessor accounting model will be substantially retained. Welcome to this KPMG podcast covering an update to the FASB-IASB Joint Project on Leases, with a focus on lessor accounting. Today we'll discuss project status and provide an overview of the key decisions reached through December 2014. My name is Dan Amat, and I'm joined here today by Robin Van Voorhees. We are both senior managers in KPMG's Department of Professional Practice. Robin, can you begin with a status update on the project?
Sure, Dan. So this project was added to the board's agenda in 2006, and since then the boards issued 2 exposure drafts and are currently redeliberating the second of those 2. Now, at the onset of this project, the board set out with 4 main objectives. Unfortunately, the boards will not attain the majority of these objectives, but it appears they will achieve their primary objective, which was to recognize all leases of lessees on balance sheet. Now, the boards only have a few more topics to discuss and to redeliberate before they issue their final standards, but to the best of our knowledge, their discussions specific to lessor accounting are complete.
You say the boards have only a few topics left to discuss. So when can we expect a final standard, and what does this mean in terms of an effective date?
So we would expect redeliberations to be substantially complete in early 2015. And based on the time it would then take to draft a final standard and complete a fatal flaw review, we would expect to see a final standard no earlier than late 2015. So that would take us to an earliest likely effective date of January 1st, 2018.
Okay, so what are some of the major decisions to date that will impact or have a specific bearing on lessor accounting?
So let's start with lease definition. And the boards agreed here to retain the definition of a lease, as proposed in their 2013 exposure drafts, but they decided to provide further clarification about when and how the aspects of that definition are applied. So the new definition of a lease would focus on control over the use of an identified asset. So you have an identified asset if it is physically distinct, or if it is a distinct portion of a larger asset, and if the supplier doesn't have a substantive right to substitute another asset.
Okay, what do you mean by substantive rights?
So substantive rights by a supplier would mean that the supplier has the practical ability to substitute the asset, and it can benefit from exercising that right of substitution. Okay,
that makes sense. Can you elaborate a little bit on this control over use concept?
Sure. So a contract conveys the right to control the use of an identifiable asset if throughout the term of the contract, the customer has the right to 1. Direct the use of the identifiable asset, including changing how that asset is used, and 2. Obtain substantially all the economic benefits from directing the use of that asset.
Okay, well, tell me, how does this compare to the definition of a lease under current US GAAP, and what will the impact to lessors be of any differences?
Sure, so current GAAP lists 3 conditions, any one of which can indicate a lease. These first 2 are generally consistent with the new definition, but the third states an arrangement may be a lease if the customer obtains substantially all of the output from the asset during the term, regardless of the customer's ability to direct use. So this new definition is unlikely to change the conclusion for most common lease arrangements today, but the result could be different for outsourcing and similar arrangements that include significant services. So I'd say more generally, I think we'll see some instances in which a contract currently is considered a lease, but will no longer be considered a lease under the new guidance. And we may even see some things the other way around, such as inventory leasing arrangements, so those are not leases under current GAAP, but they might be under the new requirements. I'd like to discuss some of the changes to lease term, which have been fairly slight. So here we see that under the new standard, the definition of a lease would be the non-cancelable period plus the optional renewal period if the lessee is reasonably certain to exercise it, plus the periods after optional termination date if the lessee is, again, reasonably certain not to exercise it. So that would get us to lease term.
How would the lessor evaluate whether or not a lessee is reasonably certain to exercise options or to extend or terminate a lease?
Great question. So that evaluation would be based on economic factors that are pretty consistent with current GAAP and will be provided in the new standard. And while we use the term reasonably certain here, which is different from existing GAAP, which uses the term reasonably assured, the board said that they do not intend to change that high threshold under our existing guidance for inclusion of optional periods in lease term.
So it seems the determination of lease term under existing guidance and new guidance will remain substantially unchanged.
Yeah, that's right, Dan. So I'd like to quickly discuss lease classification test, which would be the same for both lessors and lessee. And if you take a look at this flow chart, you'll notice that lease classification for lessors under the new standard would be similar to current US GAAP requirements, but without explicit bright lines. So if the answer to any of these questions is yes, the lease is classified as type A, or like the financing of an underlying asset. Otherwise, the lease is type B, like an existing operating lease. Now, we would expect the vast majority of today's operating leases to classify as type B, and the vast majority of existing direct financing or sales type leases to be classified as type A.
Can you talk to us about recognition and how that might differ for type A versus type B leases?
So for type A leases, a lessor would de-recognize the underlying asset and recognize a lease receivable for its right to receive lease payments, and also a residual asset for its interest in the underlying asset at the end of the lease term. The lease receivable is then amortized on the effective interest method, and interest income is recognized on both the residual asset and the lease receivable. So in other words, the residual asset is accreted. And some other points I think are worth noting for type A leases with respect to recognition. So first, with regard to recognition of upfront profit. Generally, a lessor would recognize selling profit or loss when the fair value of the underlying asset does not equal its carrying amount. However, under the FASB's proposals, selling profit would not be recognized if a lease is type A only due to third-party involvement. So if there's residual value guarantee. The IASB has not proposed a similar restriction. Also, leveraged lease accounting will be eliminated prospectively under US GAAP, but existing leveraged leases would be grandfathered in transition.
Okay, thanks, Robin. So how did type A leases differ from type B leases upon initial recognition?
For type B leases, the lessor does not de-recognize the underlying asset. It will remain on the lessor's balance sheet. A lessor also will not recognize a financial asset, as it would for a type A lease. And then lease income is generally recognized on a straight-line basis, and there is no recognition of interest income. So for these types of leases, lease income may differ from lessee's total lease expense if there are differing assumptions about lease term, purchase options, etc. Also, the lessor's underlying asset does not equal the lessee's recognized financial liability. Now, we haven't discussed scope exceptions, but leases of lessors that are short-term in nature, or generally those with a lease term of 12 months or less, would be accounted for similarly as these type B leases.
What else can you tell us about lessor accounting that's maybe different from current GAAP or where the board's decisions have diverged?
Right, so while there are not any significant aspects of lessor accounting where the board's decisions have diverged, I can highlight some other key areas where the decisions are different from current GAAP. And first here, initial direct costs, or incremental costs to obtain a lease. They will differ for type A and type B leases. And going even further, for type A leases, the accounting for initial direct costs would be different depending on whether or not selling profit is recognized at lease commencement. So for lease modifications, generally defined as any change to the contractual terms of a lease that are not part of the original terms of the lease, a lessor would account for type A modifications under the existing financial instruments requirements in US GAAP or IFRS. Type B modifications would be accounted for as a new lease. And the last point I think that's worth noting is on lessor disclosures. So the board decided to substantially retain and to further enhance the existing disclosure requirements for lessors. And in response to feedback from users, the board also decided to require lessors to provide a table or a reconciliation of lease income recognized during the period.
Robin, where can our audience go for more information on these specific topics or on lessor accounting as a whole?
That's a great question, Dan. So our Defining Issues publications on leases summarize the board's latest redeliberations, include illustrative examples, KPMG observations, and these publications are available for download on the Financial Reporting Network's Latest on Leases page. We will also release a more in-depth publication on leases when those final standards are eventually issued.
Great. Thanks for the update, Robin, and thanks to our audience for tuning in. Please visit our Financial Reporting Network for more information on the FASB and IASB's joint project on leases, as well as for other ongoing projects and recently issued standards.